Hey everyone, my name is Ayodeji Oluwalana, and thanks again for joining me in this financial series for Panapa. Today, I'm going to be talking to you about the principles of wealth creation, fighting financial ignorance, the financial miseducation of the middle class. You want to know why 95% of Americans end up poor, and how to fix it. Like I said, I'm a licensed financial professional. Um, I work with different companies. I'm an independent financial professional licensed in almost 10 states, about 10 states. And we have a power of choice. There's so many companies that we work with, Transamerica, Voya, Aegon, Prudential, name it. And it gives us, we work with different uh, uh, portfolios that you will like, estate planning, debt and tax relief, um, car, um, home, pet insurance, or name it, time with living benefit, college savings fund, tax-free retirement, and all that. Those are services that we provide. I want to also kind of mention, I should say, excuse me, preparing for the life journey. Many of us came to America for, greener pasture, and you really, really want to understand how wealth are created in this part of the world. So you need to start thinking about preparing for life journey. You want to ask yourself, does your portfolio, your current portfolio, if you have any, does those portfolio have all you need in this country? And one thing I want to also mention is we need to start thinking about saving for your future. In the previous videos that I made, I shared different ways you can start investing and start, diversifying, your portfolios. Um, we live in one of the wealthiest country in the world, and one thing I've realized, in this country is that you can work hard all your life but still retire poor. And that's why you see those, some old people, still working, odd jobs. You see some of them are warmer. You wonder, why is this person still working? It's just because some of this information that I'm sharing with you or I'm going to be sharing with you, they were not privy to this information. And again, one important thing that I also want to highlight, I know some of us have family, some of us don't yet. Uh, but this is a fact that we do so much, for our kids, to raise them to be, who they are made to be, right? And in this part of the world, there's so many people, walking around with student loan. You don't even want to think about it. Some of us that came to this country as international students. We are very lucky that we got fully funded, full funding, and we don't have to worry about debt after school. But most people in this country have college student loans, and it's really not fun. And one mistake we do not want to make is we don't want to raise our kids and to actually see them, finishing, college with lots of debt. And one important thing I want to highlight here, talking about saving your future, is you need to understand how money works. And understanding how money works is essentially part of taking care of your family. It's a very critical component of you taking care of your family. And again, it's a matter of fact that we all want to, have a comfortable retirement. But the question is, do we have a plan? You might think you're still a student, you worry about that down the line, but I think you should start thinking about it right now. We all want to retire. For some of us that wants to be here long term, you need to start thinking about what your retirement is going to look like. And also, this is something that someone told me, years ago, and for me being a licensed financial professional, I realized that this next bullet point is very, very true. There is nobody more interested in your future than you. There is nobody more interested in your future than you. So that's why you have a responsibility. And what's your responsibility? You need to understand money. You need to understand how it works. You need to understand how to make it work for you. Most of us are working for money. Money can work for you, right? You need to understand how to make money work for you. And the difference between successful people and unsuccessful people is that successful people do the things that the unsuccessful people don't want to do, right? So, when you see two people, one person is successful, the other person is unsuccessful, you ask yourself, what went wrong? And you discover that, successful people always do things that the unsuccessful people don't want to do. Take, for example, your studies, if you want to graduate, with good grades, successful people, put in the work, but unsuccessful people, maybe time for, the best time for them to actually invest in their studies is the time they are just having fun all over the place. That's the difference. Again, this also is also related to, money as well. People that will see that they are successful, they did things that the unsuccessful people don't want to do. Talking about financial principles of successful people, number one rule is make money. The number one principle of successful people is that they make money but never lose money. Make money but never lose money. And rule number two is, the second principle I should say of successful people is never forget rule number one. And what is rule number one? Make money, never lose money. I love this quote by Warren Buffett. He was actually the one that give this share this rules. He was once a one of the richest person in the world, and this is some of the principles that he has shared that you know for you to be successful financially, you actually must make sure that you make decisions and put your money in a portfolio where you can make money and you never lose money. Another principle of successful people is that it's, where am I putting my money? Am I incurring management fees, or am I putting my money in a portfolio that there are no management fees? Again, don't forget rule number one, make money but never lose money. If you're paying management fees that, in a portfolio that you have, that means you're losing money. And inflation is right now it's around 3%, 3.1 is hovering between 2.8 and 3.1%. So right now inflation is 3%. Like in my past video, I talked about inflation and what that means for us. Putting your money in a checking account. Let's say, for example, $100 with inflation of 3%. Maybe by next year, inflation increases, the value of your money will actually, also increase your purchasing power for that money. So again, you're bleeding out money, right? And that is not one of the principles of successful people. Again, one of the principles of successful people is that they avoid double taxation. Taxation is in this country. You need to really understand how taxes work in this country. There's tax now, there's tax deferred, and also there is tax free. So again, successful people in this country, from what I've, from my understanding, from people I've understudied, they put their money in portfolios where they will avoid taxes, in a sense, tax free, right? So, and that's how successful people keep money and they don't lose money. And also, another principle of successful people is that there's flexibility and liquidity. You want to be able to put your money in places where there's flexibility, liquidity, and all that. Of course, this is very, very important. The power of compound interest. Successful people put their money in portfolios where they generate compound interest, not simple interest. I don't know how many of you still remember those simple interest and compound interest. Compound interest is a process where you put money in your portfolio and yield interest and principal plus interest. That's what is going to be compounding. Unlike simple interest, it's just, very, very, very basic. And I'm going to show you as we move forward in this presentation. Social Security, I'm going to talk about that. Critical and chronic illness, which is the number one cause of poverty and bankruptcy in this country. It's a very, very important thing every one of us should be aware of. And I'm going to talk about that. So successful people also plan for that as well. They plan, in case things happen, how am I going to, are they going to protect their wealth, leave a legacy for their children? Um, Talking about different financial portfolios, I've mentioned this in my past video. We have different ones: checking account, savings account, certificate of deposit, 401k, TSP, 457, 403b, IRAs, Roth IRA. Just they're all listed years. These are different portfolios that people use to either grow their money or put their money into. Don't forget rule number one from Warren Buffett, right? It says make money but never lose money. So talking about financial portfolios, right? So we have all those portfolios listed. So where you see the green um check mark, that's where you never lose money, right? So for example, checking account, you don't lose money. Savings account, it's your money, it's right there, right? Certificate of deposit, you don't lose money. 401k, 457, 403b, that, those X boxes, those are portfolios where you potentially will lose money, right? IRA, Roth IRA, because they mirror the market. We all see what's going on with the stock exchange, with tariffs and all that. Indexed annuity, life insurance, municipal bond, those are in areas that you do not lose money. So it's also very important for me to, highlight this, to know which portfolio you should, put your money into. Talking about paying financial advice or, management fees and all that. As you can see in your checking account, savings CD, you don't pay management fees. Uh, Index annuity, life insurance, municipal bond, you don't pay management fees. Don't forget that rule number one: make money, never lose money. So again, this is just a summary, of the other previous videos I've done to kind of know, okay, where best can I make sure that I'm making money and I'm not losing money. Talking about inflation, like I explained, inflation in the past, checking account, savings account, certificate of deposit will be impacted by inflation. But, there's no two way about it. Like I mentioned, having $100 in your account this year, and if inflation goes, even maybe in January, you have $100 in your account, and by June, inflation goes to 4%. The value of that money has decreased significantly, and you've lost a valuable purchasing power for that money. So also you need to understand where you're putting your money, thinking about inflation and interest rates. So there are portfolios that are kind of, it grows your money above the inflation rate, which is the indexed annuity, the life insurance, municipal bond. The yellow one are just the ones that kind of like, sometimes it grows above the inflation fee, sometimes it goes below. But with everything going on right now, in the country or globally, there is huge, huge, huge bleeding that is going on with stock exchange, 401k retirement portfolios and all that. Taxes or no taxes on interest. I talked about, there are three types of taxes in this country. Again, I'm going to repeat it. Tax now, tax deferred, and tax free. So again, looking at those portfolios, there are different portfolios where you don't pay taxes, like Roth IRA. You've already paid the taxes, you know, beforehand. So anything you make on the growth in that portfolio, you don't pay taxes on it. But for stock, and annuity CD, your checking account and all that, portfolio, you pay taxes on the interest. We call it capital gains. So for checking account, for example, even the interest is probably 0.01, you still have to pay taxes. Or if you're putting your money in a savings account, maybe high yield in your savings account, and you maybe in a calendar year of 2024, you made $200 as interest, like interest in because it's high yield savings account. You're going to pay taxes on those $200. So again, there are portfolios, these four portfolios in green: Roth IRA, Roth 401k, life insurance, municipal bonds, college funds. Those are portfolio you do not pay taxes on. access to cash, penalty free. As you can see, these are accounts that, you have access to cash, which we call liquidity, checking account, savings account, some form of IRA, stock, Bitcoin, some form of annuities, life insurance. Those are portfolios that you can easily have access to cash, penalty free. So now let's talk about simple interest versus compound interest. Albert Einstein says compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays for it. Let me shock you that the credit card that we all have, loans, they're all compound interest. So for example, if you owe $500 on your credit card and you only pay minimum, the balance will be transferred. It will be rolled over and it will be compounding. The interest will compound. Let's take, for example, compound interest. Someone gives me $100,000 at 10% interest, and I put it in a portfolio that is simple interest. And there's another person that puts that same amount in a compound interest portfolio. So first year we both earn $10,000, right? That makes it $110,000. Year two, I earned 120, the other person earned 11,000. I just want to show you the power of compounding here. Year three, 130 for me, 133,000 for the other person. Year four, 140 for me, 146 for the other person. So let's go to, at the end of year 40, how much will I have made? I will have made $500,000 after 40 years. But guess what? The person that put that same $100,000 in a compounding portfolio will earn over $4.5 million. So you see, this quote by Albert Einstein said, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays for it. So you need to understand some of these things. They are very, very important. So what are those portfolios that grows your money? Uninterrupted compounding. As you can see, there are only two portfolios in this country: fixed index annuity and life insurance, that grows your money compounding. Every other one is just, basic. That's why you see at the end of each month's bank statement, in your checking account, you see 0.01%. That's just simple interest. Again, you can imagine putting, say, $10,000 in that checking account, and you are at the end of the day, they're giving you maybe 5 cents or 10 cents. It doesn't make any sense. And that is why some of this information are very, very valuable for you to know as you begin your journey, your financial journey in this country, so that you are well informed. And this is something that I'm interested in helping you figure out if you're interested as well. Provisional income, danger of social security. Like I said, this is a little bit complicated. You might not understand this, so I'm not going to dwell more on this. I want to ask a very, very important question. How many days forward could you survive if you stop working today? This is a question someone posed to me 3 years ago. And I said, I don't know. I said maybe a month or 2 months, at the most. The reason why this question is very, very important for everybody is that chronic and critical illness are the #1 cause of poverty, like I said. And only two portfolios. For example, if someone has chronic illness or critical illness, like cancer, stroke, heart attack, things like that, and they have a portfolio, that can protect them when they are critically ill, then they are made. They can be rest assured. And I'm going to show you, give you a tangible example of what I'm talking about here. But there are only two accounts that will be able to protect you or continue to provide a form of income for you when you are not able to go back to work or continue that research, whatever. Those two accounts are immediate annuities and life insurance. Talking about life insurance, living benefit versus disability insurance. I know some of us, life insurance, like life insurance is for someone that has died, and the beneficiary will take advantage of it. There's what we call life insurance living benefits. This is a life insurance that while you are still alive, you can take advantage of it. And you can see this picture. So the one to your left or to my right is someone, maybe I think she I got this picture from the internet. She broke her leg, and this is someone that she's walking, and you know she got it because of our job. Most employers, they offer disability insurance, so either short term or long term, depending on what the company offers in terms of benefits. So she broke her leg. She couldn't go back. She couldn't go to work maybe for 6 months. Because of that disability insurance, she'll be able to continue to earn 60% of our pay until she's able to come back to work, right? So, but look at this person on the left. This is someone that has critical illness, right? This is someone that maybe is maybe kidney failure, renal failure, heart attack, or maybe cancer. The possibility of this person going back to work in the next 6 months is very, very slim. I'm not saying the person won't be able to go back to work, but the chances are very, very slim. And if this person has a life insurance with living benefits, then he'll be able to continue to you know fend for his family, pay his mortgage, or whatever expenses he has and all that. And that is why this is very, very important for people to pay attention to. And we can talk more in details if you want to learn more about this. Talking about estate and probate court, how many of you know what probate means? Maybe few. Probate, the probate court system in this country, I just also got to know about this three years ago. If you don't understand probate, then you are possibly working for probate. Probate is a court system where when a person dies, the person's assets, will automatically be frozen, regardless of whether the person has a beneficiary or not. The person's assets will be frozen until the person's estate goes into probate court system. And what that means is that all of those assets, the checking account, the savings account, every of these accounts will be frozen, regardless of the fact that this person has beneficiaries, right? So what happens is that at the end of the day, and this probate court system could take, depending on the state, it could take 2 years, it could take 3 years, it could take 4 years. I don't know how many of you remember Boswick, this guy from Wakanda. When he passed away, his estate, everything went into probate court system, and I think it took almost 4 years before the process was completed. Come to think of it, if the wife wasn't working, she's not self-sustaining. Number one, the house, if they still have mortgage to pay on the house, those will be sold. The family will be homeless. So, and because what the probate court does is that they will look at, okay, this is all your assets, right? What are all your liabilities? You have mortgage loan, you have student loan, you have every of this, debts. So, say for example, you have $3 million in asset, and you have maybe 1.2 or $1.5 million in liability. What at the end of this probate court system, the remaining 1.5 million is what the family will get, and this could take years. And that is why people go on GoFundMe, and you wonder, oh, this person is doing well. Why is the family going on GoFundMe? I must shock you. The former owner of Cash App, was shot about three and a half years ago, I believe, and his family went on GoFundMe. And this is someone that's worth $10 million. But because he didn't have this kind of information, he didn't put his money in, either in index annuity or a life insurance that can possibly protect, his asset from going to that to bypass probate. These two portfolios are the portfolio where you put your money that will bypass probate. So, for example, if this cash app owner, he might probably have money in savings account, checking account, while all of those assets, that you see in red, that's crossed in red, while all of these assets are frozen, this particular these two portfolios will not go to probate. Thereby, the family can continue to have access to funds in this money. The shocking thing about probate is that even though you and your husband have, or you and your wife have, joint, maybe you are joint account holders, and that portfolio is like in both persons, spouse's name, right? Probate does not respect that. Oh, someone is alive, the other person is dead. That account will still be frozen because the other person, that is the late person, will, he still has it tied to that account. So it's very important for us to understand, all of this. So, putting all of this together, just ensuring that, okay, we rank what kind of portfolio will I put my money where I don't have to lose money, right? So you can see, we rank them. The indexed annuity as a B plus, right? Municipal bonds as a C. As you can see, never lose money, indexed annuity, life insurance, municipal bond passes, similar to no manager, no management fees. Inflation, usually indexed annuity grows your money about 5% above the 3% inflation. Life insurance roughly about 8%, municipal bond about 4%. So no taxes. The municipal bond and life insurance and college funds and the three portfolios. But look at it, the life insurance is the one that is green all through. When you think about the financial portfolios where you never lose money, manager, it's growing your money above 3% inflation, no taxes, there's flexibility, there's compound interest, that you avoid social security taxes, you are protected when you are ill, and also bypasses probate. So again, you can, as you can see, that life insurance is one of the best for portfolios one can put one's funds into, and that your financial future is secured, and you are also well protected. So talking about different types of life insurance. So we have 4 types. We have group life insurance. This is one you get usually through your work. Maybe you get a job, the company will offer you a life insurance. That is gotten through. That's what we call group life insurance. There's also term. So term, it could be 10 years. You are insuring your life for 10 years, for 20 years, for 30 years. There's whole life, and also there's a universal life insurance. That's what we call the miracle, the family miracle. So let's go through this real quickly. Talking about group life insurance, one advantage of life insurance is that it costs significant, like it's very, very minimal. I'll probably say insignificant, right? And you can just say it's free, right? And this is offered, like I said, to full or part-time employees, but there are more disadvantages to group life insurance. The coverage ends when you leave your job. In my former job, when I left, the group life insurance ended, and it's paid only upon, mostly at work. So for example, if that person dies off work, it's most likely that the group life insurance will not kick in. No benefit to clients while alive. So like I talked about living benefits. So if the person is sick, the group life insurance will not cover anything except the person is dead, right? So illness, layoff, retirement result in end of coverage. So if the person that had a heart attack or stroke is unable to come back to work, and the person is eventually laid off, that means the group life insurance is automatically canceled. And we've seen that there's 0.9% payout probabilities. And this is deceptive. It is not considered life insurance traditionally, honestly, if you ask me. Term life insurance, this is kind of the regular one that they advertise. It's cheap. You see that, in TV ads and all that. It's temporary coverage. Like I said, you can do it for 10, 15, 20, 30 years. The ironic thing about term insurance is that, after 30 years, if you don't die, what happens? So all the money you've paid for 30 years is all gone. And by the time you are 30 year plus, by the time you're 30-year plus, you can't the cost of insurance at that age will be much more expensive. And again, it's also only paid upon death. Uh, I used to have a term life insurance, but when I became a licensed financial professional, I understand how money works. I just canceled it, and I had a term insurance for about 2 years, and I there was no cash accumulation or anything. It's just like I actually was putting water in the basket as go, just wasting money essentially. Again, it also mirrors life insurance um, and all that. Our life insurance, um, all life, age 100, premium remains the same. Cash accumulation, yeah, this particular type of life insurance has cash accumulation. It's more expensive, no benefit for clients while alive, like I said, it's similar to other life insurance, no cash value guarantee, death benefit without cash value. So talking about index universal life insurance, the advantage is we call it the miracle, family miracle. It has 62 benefits. But the disadvantage of this index life insurance is you have to pass the health physical, and sometimes when you look at the benefit, it sounds too good to be true. And if you really want to know more, please reach out to me. You have my contact information from the previous videos I have made. So again, you can't go back and change the beginning, but you can start where you are and change the ending. This is a quote by C.S. Lewis. This is something that when I heard about this opportunity and now I can grow my money and not lose money. I said, well, I made some mistakes in the past, but now that I know I have this information, what am I going to do with it? So I was able to like, okay, you know what? This is what I'm going to do, and I'm glad where I am right now. I also want to share this with you. The common tax code that we use in this country, which are all like variables. We have the IRC 408. These are all IRA tax code, the Roth IRA. So all these 401k, those are tax code. 401k, 403b, employer sponsored IRA, and all that. These are all common codes. But guess what? There are some tax codes used by a few. And these are the 7702B long-term care, IRC 72E, TEFRA, and this is how the plan grows tax deferred. I mentioned tax deferred. 7702 DEFRA, how you can take money out of your plan tax-free. And these are portfolios that are indexed. When I say index, is that when the market is good, you grow money, and when the market is down, just like right now, you don't lose money. It's locked. That's why it's called indexed. And this is where most wealthy people are using their money. I know for some of us that have students, I should say kids that eventually will go to college, one thing that we've been told, is that, oh, just do college funds. That's the IRC 529. That's college funds. We did that too. But when I had a better understanding of where I can put my money, that will grow compounding, and help my kids go to college, debt free. I decided to start putting funds away for their college in this IRC 7702, which is compounding. Again, the IRC 529 is variable. When the market is good, you gain money. When it's down, you lose all the gains, just like exactly what's going on right now. But in the IRC 7702, it's indexed, you lock your money. Talking about probate, I think I mentioned this. This is one way people protect their wealth. Probate court system is not fun, and some of these things are not taught in school, and that is why this information is very, very important. Like I said, all of this will be frozen. The only two account that will remain: index annuity and life insurance that the beneficiary will take advantage of, while other portfolios are being they are going through probate, excuse me. I love quotes. That's why I'm putting these quotes on the slide. Robert Kiyosaki says, it's not how much money you make, but how much money you keep. how hard it works for you and how many generations you keep it for. For me, since I became a licensed financial professional, I realized that being financially successful is not rocket science. You just need to understand how money works in this country, and that is the information I'm providing, for you. Number one cause of poverty, like I said, stroke, heart attack. I also asked this question: how many days forward could you survive if you stop working today? And again, you want to think about what can I do? Where can I start putting my money? Where I will have income protection in case, life happens with critical illness, and I'll still have access to some fund if I can go back to work. And that's what life insurance living benefits will do for you. Talking about the story of Scott, exactly talking about this previous slide, income protection. This is Scott, who is also one of a colleague in the state of Florida, where I'm also licensed. He, is a father, a husband. He loves God, and Scott is a very, very active person. He loves to run, do exercise. But one of these days, Scott was doing all of that, and he actually collapsed. And before we knew what was happening, he landed in the hospital. Scott suffered an heart attack, right? So when he did that, it was like, what am I going to do? What's going to happen to my family? My assets and all that. Then he now remembered, like, oh, I have a life insurance that has income protection, living benefits, and because what happened to Scott is classified as a critical illness, he qualifies for the living benefit from his policy. And thank God he was able to protect, his family. He was able to protect everything he had. Had it been he doesn't have a life insurance with living benefits, you know, everything would just go down the drain because he couldn't go back to work almost immediately. I think he was in the hospital for more than 6 months. But thankfully he survived. And guess what? Scott had a $500,000 policy with living benefits. Because he had a critical illness, Transamerica, which is one of the companies that I work with, were able to write Scott a $353,000 check. And guess what? Scott says he's so grateful to be alive and living his dream. What Scott immediately got the check, within 2 weeks after he filed the claim, he was able to pay off his mortgage, pay off his car note, and said he's living his best life. So again, this is information that we, have always been sharing with people. If you think education is expensive, wait until you see how much ignorance costs. And we've also seen people that heard about this information and they never there's like, oh, it's just one of those things. There's a nurse practitioner that also heard this information. This happened in New York. A mother of two, single mother of two, and yeah, I think she was into several shifts, and I think it was this happened 2 years ago actually, and um there was a particular week she had to work more than maybe 80 hours in 3 days, so she was stressed. So at the end of that shift, went back home, and I think she slumped and died. And because of the fact that she didn't die at work, the group life insurance didn't kick in. So committee of friends came together and say, let's see what we can do. They went on GoFundMe and see how much they raised. At the end of everything, $1,132. This is someone that has a house, that a mortgage that she's still paying for, has 2 kids and all that. Had it been she got, when she heard about this information and she acted, she won't be able, the family that she left behind won't be in this kind of situation. The 21st century, it's things are changing, and it's necessary to have our children come out of college debt free. You don't want your kids to come out of college with $50,000, $100,000 worth of debt. That's not how to build legacy. And that's the best gift we can give to our children, to ensure that they go to college debt free. Some of them might get scholarship, but with everything going on right now, with the way things are going, I don't think eventually there will be full ride. or something that you can't really guarantee that your children, is going to get a full ride. Why do you want to put, put all your eggs in one basket, while you are able to make, informed decision right now. Never let formal education get in the way of your learning. It is very important. Some of you might know, my background is in sustainability, but I discovered that, when I heard about this 3 years ago, I said financial education wasn't taught in school. It doesn't matter your discipline, your PhD, your master's holder, your major, your expertise. The issue of financial education is very, very important, and unfortunately, it's not taught in school. And 20 years from now, you will be more disappointed by the things that you did not do than by the ones you did do. And this is a quote from Mark Twain. So again, I want to look back 20 years into my retirement and say, wow, I'm glad that I took this decision 23 years ago, and I'm comfortable where I am right now. My kids are doing well. They went to school, college, debt-free, things like that. So again, that is where everybody should be thinking about. And for some women, women, they often bear the brunt. Say, for example, they don't have anything to do with finances, so it's all their husband. Or they will say, I assume my husband had all the finances in order. Some ladies just don't, it's not their thing. They don't you feel like, oh, their husband will take care of it. Oh, I assume, he will take care of me and the family. I assume that nothing bad could ever happen to me or to our family, but I assumed wrong. This is a reality I have personally seen, where husband died, and this is what the wife was saying. That I wish I knew this information all this while. We could have actually take the right decision. I know two people right now that they are going through probate. Their husband died, and they are going through a probate court system. One of the women, the husband died 2022, late 2022. Up till right now, this is 2025, the probate court system is still active, it's still ongoing, and the husband asset is still frozen. Thank God the woman is also, she was working, or she's still working, to be able to survive and keep paying their mortgage. But it has not been easy. I didn't been, they have this information earlier on, maybe this could have actually saved them a lot. So as I wrap up this slide, life insurance is like a parachute, right? If you don't have it the first time you need it, there is no second chance. Life insurance is a parachute. If you don't have it the first time that you need it, there is no second chance. So as a wrap up, I believe in financial education. This is a book I would highly recommend that you read. All of the things I've talked about, and also how companies are putting their money in life insurance. You ask yourself, what are companies, notable companies, banks, as you can see, Bank of America, Wells Fargo, this is where they have their life insurance assets. So this is a book I would highly recommend. These are companies that also have assets, life insurance assets, and you ask yourself, why are they putting money, huge amount of money in life insurance? Again, this is another book, The Family Bank Strategy. This is a book I would highly recommend for people to read. And if you want to talk more, please feel free to reach out to me. You have my contact information from a previous video. Feel free to reach out to me and we can talk. I want to thank you for your time, and I will see you around. Thank you.